if somebody's looking to buy a home right now, what advice would you give them today?
Well, it's still a good time to buy a home. You just have to be a little bit smarter, I think. I'd still advise people that it's a good time to buy, because the one thing that all the podcasts that I watch and pundits I listen to, prices aren't going to make a dramatic drop. So that $200,000 home 5 years from now is going to be $250,000. It's not going to be $150,000. So you may have it at a lower interest rate, but you're going to pay a much higher premium for it. So they still encourage people, just buy smart and do your, work with your real estate agent and make sure that you're buying it at the right price.
You're listening to the Isn't That Rich podcast, and we're your hosts, Jill Franks
and Ashley McVicker. As young females in the banking industry, we love simplifying the confusing yet everyday questions you have about money.
Like, how do I get my finances in order?
Where is my money really going?
How do I invest for my future?
How do I make my money work for me?
Can I really afford to buy that new home?
These are the questions that keep us up at night. And the truth is, no one was born knowing how to handle their finances.
And chances are, walking into a bank to ask for help seems intimidating.
Whether you're a single person in your early 20s saving for your first home,
or you're an empty nester wondering what to do with that extra spending cash,
this is the podcast for you. Today we are sitting down with Chief Mortgage Officer John Streuter for a mortgage market update. John has been in the banking industry for over 38 years and has been in mortgage lending for over 32 years.
John is an active member of the Carterville Chamber of Commerce and has been a member of the Marion Chamber in years past. He has served on the board at Methodist Children's Home for 16 years, has been a Rotarian for over 25 years, and was the charter president of the Carterville Rotary Club. John, welcome on.
Welcome. John. Hi.
We're glad to have you today, John.
I'm glad to be here.
I'm happy to have you here.
Looking forward to our conversation.
Yeah, and we used to do Mortgage 101 together.
We did, and this will give us an opportunity to go a little more in depth to some of these subjects that we're going to talk about, rather than the short synopsis that we gave people in Mortgage 101.
Yeah, I think so too. But John, I'm going to jump into it because it's not new news that the mortgage industry has been a little crazy over the past few years, and it's kind of been all over the place. So I want to start off today by asking you the question everybody is wondering: what in the world is going on in the world of mortgages?
Well, I'm sure that there'll be a ton more questions, and excuse me, I use my hands a lot when I talk. So, yeah, things are crazy. I've been doing this 38 years, and we're in a time element none like I've seen in that 38 years. Some of it we have, but to kind of start off with is we're in a period where we're seeing high interest rates, low inventory, high inflation, and the government doing some crazy things that is just making a real crazy storm right now in the mortgage industry, and buyers and sellers and lenders are all, is it a good time to buy a house? Is it a good time to get a mortgage? Everybody's kind of on edge, and hopefully we'll be able to calm some of those fears today with the conversation that we're going to have and bring some people at ease.
And isn't that funny that 2 years ago when the interest rates were super low, everyone's like, is this a good time to buy? Is this really? And now we're like, is this a good time to buy? And it's like, you've probably heard that question over and over again in your 32 years of lending.
It's a shame that over the last, during 19, 20, and 21, and even part of 22, that people didn't jump in at that point in time when rates were as low as 2.5%. I actually did a couple mortgages for people at 1.95%.
You're kidding me.
That's free money.
That was the lowest I ever saw.
Say that again.
1.95% was two of the lowest ones that I did. But we saw a lot of people in the mid twos, a lot of people in the 3% range. Today, we're looking at 6.5% on a 30-year mortgage. So, and depending on your credit score, could even be as high as 7.5% on a 30-year mortgage. So, I wish a lot of people would have jumped in. Don't know how we would have handled it. We did, during those years at Farmers State Bank, we did 5 times what we normally do.
Oh my
in
gosh.
That's crazy.
So it was a boom year. And when other lenders, other institutions were turning people away saying, we're only doing it by appointment and our appointment is booked out for 3 months, our team kept on taking applications and just putting in the hours. So
yeah, I remember how crazy it was around the bank during that
Yep.
time. I remember our mortgage team was working like crazy and the operations team was working
team.
like crazy to process everything. It was just a crazy time, and nobody could step foot in the bank. And so you're doing all of this stuff with, just a crazy time to be in the industry.
I had just started at the bank, so I was like, "What's an interest rate?" And my parents were like, "You
What
really
is-
should buy a house
what
right
is
now."
a
I'm
mortgage?
like, "No."
Yeah.
Now I'm like, "Well, dang."
Missed the boat.
But you would still say interest rates are good.
Yeah, it's, again, I've been doing it for 38 years. When I got started in the 1985, a fixed mortgage rate was anywhere from 13 to 16%. Adjustable rates were in the 8, 9, and 10% range. So rates are still, I just said 6.5 to 7.5. So rates are still phenomenally good.
Relative to that, for sure.
When I started as a collections officer, and
That's fun.
I was collecting on loans on people who had 6% interest rates, wondering, why are they letting their house go back to the bank when you're never going to be able to get a mortgage that low? I mean, we never anticipated. In 1990, I bought my first house, and the interest rate was 10.125 on a 30-year fixed rate.
I feel like people our age have no idea, do they? I mean, they have no idea what
And that brings to what part of the problem that we're having these days is educating that younger population, because right now, Generation X, the millennials, and I'm not sure what the generation is after that.
It's a Gen Z.
Gen Z.
Gen
I think
Z.
it's me.
Okay.
I think I'm right there.
So that group is the largest buying power right now. Because the baby boomers, I'm the last of the baby boomers. 1963, 1964, I was born in 63. That's the last year of the baby boomers. And so we've all bought, we might downsize, but we basically are out of the buying market right now.
Well, for sure, out of the mortgage. You know,
Right.
usually people at that age are paying with cash or reselling their home and buying something smaller, like you said. So
Gen Z is, frankly, Gen X is my sister, and so they have a little bit of idea that rates were higher, but not to the level that my generation and people older than me have seen. Millennials and Gen Z have never seen rates above 5%.
yeah,
And so this is...
We're all
like,
having a heart attack.
You're having a heart attack. Exactly.
but is it
Because
justified?
yeah.
Is it scary? Is it
comparison is the theft of joy. So
Yeah.
if you do the math and you see that this $100,000 house, let's say, costs what it would be at 2% to what it is at 6%, you're like, oh my gosh, what was I thinking?
Yeah.
Well, and you're also dealing with the fact that your parents just got a mortgage that if they still had a balance, they just refinanced their mortgage at 2 or 3%. Now you're looking at either buying or building a house at 6.5%, 7%. And I've told a few people, if you're looking at building a home, and I kind of even introduced this idea to you yesterday when we were talking about it. If you're building a home today, you need to base your payment expectation at 8%, because that's where rates are going right now.
Yeah.
Short of something happening in the economy that causes rates to come down. But right now, rates with the Fed's meeting 3 more times this year and likely going to push rates up, it's very possible that we're going to see somebody who builds a home, it's going to take 6 to 9 months to build a home. If you can get all your supplies, we're seeing homes taking 12 to 24 months to build right now.
Yeah.
But there's very possible that we're going to reach 8%.
So you do
before
think
rates come down.
the interest rates are going to continue to climb this year?
This year they are.
And I want you to talk about why, because I think
Okay.
we
Yeah.
say that a lot. Interest rates are going up, but talk about who makes the interest rates go up and why. And maybe
Okay.
that you might have a very long answer for us, but
It is, because it's very complicated, and I want to try to make it as brief as possible, but
And
as
explain to our listeners
layman's-
what the Fed is.
in layman's terms. So what the Fed is what we call the Fed is the Federal Reserve System. That's the central bank for the United States. They are the ones that hold all the federal government's funds, monies. They hold they're responsible for the gold deposits and everything. And they control our monetary system.
Okay.
They were, I should have looked this up to have the exact year, but they were brought forward in the early 1900s to establish a central bank system and control how money is circulated, because in the 1800s, even through the Civil War, states issued their own monetary system. States actually, if you know a few bankers, some of these banks that were established in the 1800s, they'll have in their safe some of the what were called notes issued by their bank. I know some people in Murfreesboro with Murfreesboro Bank and Trust, and they have some of the notes that were issued because banks even issued those notes on the authority of the state. So the federal government, well, fast forward, federal government realized we needed a central banking system and established the Federal Reserve. And so the federal, if you ever look at your dollar bills, it's all based on the Federal Reserve issued by the U.S. Treasury Department. So when the Fed raises rates, that's a rate to banks. What they do is they lend to banks. If we can only lend, generally a bank only wants to lend 85% of their deposits.
Right.
So what we do is then if we have a boom in business and want to do more loans, we can borrow money from the Federal Reserve to then make loans to people. And so when people hear the Fed funds rate, that's the rate that the Federal Reserve lends money to us as a bank.
Okay.
So then that then leads to when the Fed raises or lower rates, that has an impact on the stock market. Mortgage loans are funded by bonds called mortgage-backed securities, because banks and lending institutions can only lend so much of their deposit base on real estate loans. We
Right.
can't use our entire deposit base on real estate loans. We can only use a very small percentage.
I didn't know that.
Well, think
So
about
interesting enough,
Yeah.
when I got started in the business, there were banks years ago in the 80s and even before then that would say, no, we're loaned up on our mortgage balances. We don't have any, we can't make any mortgage loans because
So we
we're
can't,
loaned
if you
up.
want to buy this house, you can't do it through this bank.
Can't do it through this bank because we don't
Yeah.
have any money to lend you. And that was
Right.
based on, so what banks do is they now, Fannie Mae and Freddie Mac were created. Fannie Mae in 1933 and Freddie Mac was developed in 1973. They buy those mortgages, so they refund us. We still service those loans.
Right.
So the customer still thinks that they're working with us, which they are, but we've sold the capital of that.
Yeah.
And then Fannie Mae and Freddie Mac package those and put them in the stock market as they get their money from investors.
Yeah. That's why, and then it gives us that money back to reloan
Right.
to the public. So essentially now we have that money to reloan out.
Right.
Yeah.
So what happens is the Federal Reserve moves money up and down. That impacts the stock market, which impacts bond buyers. And bond buyers will buy mortgage-backed securities for longevity. If they want a certain interest rate for 10, 15, a lot of pension funds buy mortgage-backed securities. So they want to be able to buy a mortgage, or they want to buy a mortgage-backed security at a certain rate, and that's what then determines their mortgage rate. So as investors want higher rate return, we have to raise the mortgage rates in order to give those investors the higher rate return.
Right.
So it's all kind of just this system.
It's a system.
scale,
It's a
isn't
very
it?
very complicated system that because we get calls as soon as people hear that the Fed is going to raise rates. Oh, I need to lock in my rate. Well, sometimes if the Fed raises rates too much, that gets the stock market scared, which pulls back on bond buyers and actually allows mortgage-backed securities to drop and allows mortgage rates to drop. So it's a very just complicated system that changes daily. And so I tell people mortgages are a commodity now. Mortgages, basically the mortgage rate changes the same way gold price changes. You'll see if you watch gold or silver on the stock market, commodities market, you'll see daily how the price changes. Now sometimes that price is so small that the rate still stays the same, because for banks, the interest rates change down to 1/100th%.
1/100th.
But we only quote rates on 1/8%. So a fixed rate today is 6.5, but the way the bank buys that, that goes down to 1/100th of a point, which we call points. And so
Well, because homeowners can buy down points. I've heard that.
yeah, they can pay points
Yeah.
to buy the rate down.
Right.
And
So that's kind of what that is.
Right. Bank has to determine how much, and basically it's you're paying an upfront portion of your interest in order to have a lower rate over the long term of your loan. And so you can pay points in order to, so 1 point, which is 1% of your loan, generally will drop the interest rate by 0.25%. Sometimes a little bit more, sometimes a little bit less. But
it could help throughout the lifetime
Right.
of the loan to not have to pay all that interest if you do a 30-year
correct.
mortgage.
Yeah, if you're
or
going to
something.
do a 30-year mortgage on your forever home,
Yeah.
you definitely want to look at paying points. I calculate for borrowers that it takes 7 years to recoup to get a break-even point, 6 to 7 years. So if you're only going to be in that property 5 years, you don't want to pay any points.
Okay.
But then I use a 10-year calculation because I tell them, I don't want to give you $100 just to save $100. What's good is that? So 6 to 7 is the break-even point. 10 years is when you've actually saved enough money to make it worthwhile for you to have paid points.
That's good to know.
So-
So 10 years with points.
Right. 15-year loan, you really have to get a good interest rate to make it worthwhile to pay points on a 15-year loan. Points is more for a 20 and 30-year loan.
Okay. So forever homes, think about points.
Right.
Okay.
So where that brings us back to where rates are today, the Fed's been moving rates up, but what happened in 2008 when we had the mortgage meltdown and the economy went kaput, the federal government had to do something to incentivize people to get, because the real estate market drives all the other markets. It drives your home store market, which drives every other business, and there's so much related to the home industry. So they had to encourage people to start buying homes again and needed to bring interest rates down. So what the Federal Reserve did is they told the Treasury, okay, we're going to buy Treasury bonds at a lower rate. They artificially pushed rates down by telling, because normally it's investors in the stock market that's buying the Treasury notes. They started telling the Treasury Department, we'll buy the notes at lower interest rates, and that helped bring rates down. And they just kept on doing that until we reached this point where rates got down to 2%. So in 2018, the federal government came and said, okay, we can't do this anymore. We're going to slowly stop doing it. So in 2018, we started seeing interest rates inch up again, but then COVID hit.
Well, because what were rates before COVID? I feel like they were 4%, 4 to 6%.
They were
somewhere in
they were
there.
edging into the 6%. We were
Yeah.
doing a lot of 5.5, 5.75 rates
Yeah.
in 17 and 18, and then COVID hit, and the Federal Reserve said, okay, we're going to back off of our original plan, and that allowed rates to come back down. and that allowed rates to go to this phenomenally 2% low rate. And then finally in 2022, the Fed said, okay, we've got to stop this completely.
Yeah.
And inflation started in, and the Fed started raising rates rather than artificially pushing rates. And not only did that, they had to sell all these bonds at 1% that they had in their portfolio out in the marketplace. Well, there's not a, for an investor to say, I'm going to buy $1 million worth of bonds at 1%, you've got to discount that to 600,000, or if I'm only going to pay you 600,000. So the Fed's actually losing money by selling these bonds out on the open market. And that's what's just caused this astronomical increase in interest rates. And I'm sure an economist can say, oh, John, it's much more complicated than that. It is, but that kind of gives people that idea. People heard the words back in 2010, 2012, quantitative easing. So the federal government said we're not going to do quantitative easing, or the Federal Reserve said we're not going to do quantitative easing anymore, and that's what's caused this astronomical rise in interest rates.
Okay. Well, I mean,
wow.
That's a lot to digest, smokes. And a lot happens behind the scenes that we don't know what determines that interest rate.
Yeah, and it's kind of funny when people come to the bank to get a mortgage, and you probably can speak to this a lot more than I can, but everyone just thinks it's Farmers State Bank that chooses the rate, and that's what you get. And there's a whole lot of business behind that.
Yeah.
There's a whole lot of people telling us what to do.
Yeah.
Well, and it's the same thing as the retail market. People say, well, the rate's the same. Well, it's not the same between banks, because banks then sell that mortgage, and that's how we make money. We don't make money off the interest that's collected. We make money off of originating that mortgage and then selling that mortgage. So it's just like any other retail product where you sell it at this, you produce it at this rate, you sell it to a middleman at this rate, and then eventually Walmart, Target, and they buy it at this, and everybody puts their little cost on top of that. So
it's a great
it's
way
the
to look at it.
same in the mortgage business, that we're getting available money from Freddie Mac, Fannie Mae to lend out. We put our profit margin on top of that. Fannie Mae, Freddie Mac puts their profit margin on top of that, and then eventually the customer gets that particular rate. And Bank X may have a little bit different profit margin. Bank Y will have a little bit different profit margin, and Bank Z will have a. Now, because the business is so competitive and everybody can go anywhere, you're not going to see a whole lot of differences between those rates.
Yeah.
Because if our rate is here and Bank Z has got their rate here, I've got to then be at that level.
Yeah. Or that bank's doing something that they can't sustain.
Well, and that happens a lot.
Yeah.
And we're starting to see that with CD rates. I cannot imagine how some of these banks are going to sustain themselves with these higher. I think their thought process is CDs are going to continue to go up. And that they're offering a lower rate at this point, but when you're offering commercial loans and mortgage loans at 6.5%, and you're bringing money in at 5%, that's a 1.5% margin. A bank at a minimum needs 2.5% margin just to pay the bills.
Yeah, it's pretty hard to pay your employees a fair wage if you're not making any money.
People think banks make extraordinary amounts of money, and at times we do when there's a diversity between savings rates and lending rates, but our margins are only 2.5%, 3.5%, 4.5% type percentage rates. We don't, the average margin at Walmart is 30%.
I was going to say, when you look at buying a business, they say to look at anything between 10 to 30% of a profit margin, and a bank is only making a 2.5% to make end meets. It's just kind of, there's a wrong perception out there. Yeah.
I have a question.
Yeah.
So, well, I'm kind of.
That's a lot of information.
It is. It's great information that people need to know. We talk a lot about what happened in 2008, correct? I don't remember where I
was
was in
gonna say,
2008. I don't know
junior
what
high?
grade I was in. But,
Elementary,
Grade
I
school.
feel like.
you know, if you get online, you get on TikTok and you see everything that's trending right now, everyone's like, we're going into a recession or a depression. And I don't know if you can give us a final answer for this, but what is the difference between us now in 2008? Because I think people love to compare apples to apples, and it's just simply not the same thing. Am I wrong?
No, it's not. And I'll even roll it back to 2001 when the Twin Towers were attacked and 9/11 happened. The stock market then realized we didn't have certain safeguards. And so they put certain safeguards because the stock market just dropped. We've had worse drops in the stock market than they did in the 1933 crash. But we've learned things from that crash that the stock market doesn't allow to happen. And when the mortgage meltdown happened, some of the things that they did at that time is they put some hard stops on. There was a lot of electronic trading at that point in time, and they put some hard stops in the electronic trading that doesn't allow, after a certain point, they just shut down the market. The market closes. So that's one thing that's different that won't allow us to go in such a large recession as we did. The other thing that's happened is Freddie Mac, Fannie Mae, or the government required Freddie Mac and Fannie Mae to get a little bit stricter. And so we're not seeing quite the housing bubble that we had prior to 2008.
What does that mean?
Housing bubble means that housing prices are going well beyond what the true value of that home is because there's more buyers than there are sellers. And so a house that should sell for $200,000 is selling for $250,000. And then that house is being flipped in 6 months to sell for $300,000. So we had all these builders out there building homes, and the prices just kept on increasing. So we had more people in the housing market than we really should have. We were people that couldn't really sustain a mortgage payment, were able to get easy mortgage terms. And so I could go into a whole lot of politics about this, but I won't. There were things that caused this bubble to happen. Well, in 2008, there were a couple of large investment bankers in New York, Wall Street, that had invested in these mortgage bonds, that had realized that these mortgages were what they thought A-rated mortgages, and then came in to find out that they were D-rated mortgages, and started having tons of defaults. And Lehman Brothers was probably the biggest one, if people remember, that finally crumbled under the whole financial system. And there were going to be 2 or 3 other major financial banks. And that's where we get work, Community Bank, and a lot of these problems are caused by these New York financial banks that are not generally lending to the average customer and getting money from the average customer like we do. So they're the ones that have got us into that trouble, and they were going to collapse before the federal government finally stepped in, and that's where, too big to fail concept came in, that it would be a complete financial collapse. So the federal government realized that they have to step in, as they did with Silicon Valley Bank.
Just recently.
Recently. That was another situation where they made some bad decisions. Most of their money was invested in bonds, and those bonds were underwater, and some major depositors came calling and said, we want our money back. And they said, we don't have your money. They're invested in these bonds that are underwater. And then word got out to the average public who used Silicon Valley, and you had a run on the bank, and that's when the Federal Reserve had to close it. So we don't have quite the housing bubble right now, and but to a certain level, I'm getting concerned because we're starting to make some of the same mistakes that were made in 2004 to 2007.
Who's we? Our country?
The federal government, our country. The federal government is starting to push some ideas out there that are Because right now, at least still in Southern Illinois, we have a housing shortage.
I was just going to ask that. What is the inventory right now in Southern Illinois?
We have more buyers than we have sellers, because sellers have to go somewhere. And like what's happened in previous years is you'll find people like my family, my wife and I, either wanting to downsize or buy the dream home because we're at a point where we could buy the dream home that we wanted to, or downsize. But I'm sitting there saying, Tammy, no way, we're not going to do that. We have a 3.5% mortgage. I'm not going to take a 7.5% mortgage on your dream home. Right. Sorry, just not going to happen.
Sorry, Tammy.
You have a lot of people my age that are doing that, are saying, I'm not going to buy that next level home. So that keeps our home from going on the market. So that's the thing with the housing market is homes at this price range get sold to people who want to buy a house at this price range, but that person is looking at houses at this price range, who's looking at houses at this price range. And these people are building that dream home, or going to Florida and buying their dream home down in Florida. Home. So you don't have that stair-step process happening right now. So all these young buyers that are in the market, there's no homes on the market for them to buy.
Or if they're on the market, they're terribly terrible.
Or they're priced at $900,000
with a broken window,
which for
$1 million
entering the business world is just unfeasible. They can't pay or qualify for a loan for that. So, yeah.
And the storm that's added to that is inflation, because people can't afford right now to go fix up their homes because the cost of materials has gone outrageous. And added to the problem, in years past, when we have a shortage in the housing market, builders would fill that gap. Well, right now you can't build a home for what you're going to have to sell it for. Yeah. An average 1,800 square foot home is going to cost you nearly $300,000 to build, and you're only going to be able to sell it for $245,000, $250,000. And there's no contractor that's going to take a $50,000 loss to build a home. So right now, contractors are simply doing custom homes where you make an agreement to pay this price, regardless of what it appraises for. You're going to build this home and pay whatever that cost is. Mm-hmm. And we're seeing a lot of that in the construction right now on custom homes. Borrowers are finding out that the house doesn't appraise for what they put into it, but they're they're building their dream home and
So I want to stop you right there, because this is something that I know we've talked about, Ashley, is so somebody goes to build their new home and they get a construction loan, they build their home, and then it comes time to get permanent financing. But in order to get that permanent financing, they need to have it appraised. And that's where the problem's happening, is that appraisals coming
It's actually less. Early on.
Okay.
Some banks will do that. Traditionally, what we do is we appraise it early on so that we know going into it, are we going to have enough equity there, and not just string on the buyer to say, here, build this $300,000 home that we're only going to be able to finance $200,000 on because it only appraised for $250,000 and you have to have a 20% down payment. So we've had some construction borrowers that unfortunately we weren't able to help because they didn't have the additional cash to cover that difference between what we can lend on it based on the appraisal. But there are some situations where borrowers have gotten themselves in a bind where they didn't appraise it beforehand. They just say, oh yeah, we're going to lend off of the construction cost. And then all of a sudden they find out, well, it appraises for what you owe, so now the only product we have to give you is this particular loan. So we try to do our due diligence on the front end to say, here's, some people get mad at us because, well, why won't you finance this $300,000? And, and we understand that frustration, but, in the end, we're trying to look out for everybody's interest. Their interest is the bank's interest.
Yeah. We talked about that before too. Sometimes the best answer a borrower can hear is no, not right now.
Yeah. Because what happened in 2008 was all the people that weren't told no all of a sudden realized they were getting adjustable rate loans and their rates were going into the sevens from previously being in the fives, and they couldn't afford it at 7%. Right. And that's when that meltdown started happening and the default started happening, because all these were adjustable rate mortgages that borrowers got into, and they didn't plan for taxes and insurance. When it's a new home, the taxes aren't fully fully assessed at that point in time. And all of a sudden, these cities and counties started saying, well, your house is now worth $300,000. You bought it for $250,000, but it's now worth $300,000. So their taxes started inflating, as well as their mortgage payments started inflating, and that's what caused that downfall. And people started just letting their homes go back to the bank.
Yeah.
But their paychecks didn't inflate.
No, correct. Their
That's the problem.
paychecks weren't inflating during that time.
And that's
so
kind
they
of
couldn't
happening
keep
now
up.
too, right? We can't keep up with inflation right now for income.
Correct. Inflation is great right now. The average increase in income is 3 to 5%, and inflation last time I saw was right around 8%. So,
have you seen in your career, like, when, I guess, for easy terms, paychecks caught up to inflation?
Many times they do. I mean, when in the 80s.
Can you give us a year?
Well, in the 80s and 90s, income was directly related with inflation. So inflation was only in the, if you go to the Jimmy Carter administration, 76 to 80, inflation was double digits at that point in time, and income wasn't going up at that level. And so there was a lot of financial problems at that time. 1980, you started seeing that rate come down. So by 82, 83, you started seeing the inflation rate and the consumer price index started meeting a little bit more, and income was, and that's where in the late 80s and the 90s, we flourished because income was increasing at the similar or greater rate than inflation. And so talk to your parents, and we all say that
the 90s were great.
85 to 2000 was great time to live. That's everything was going well, and then 2001 happened, and
So I'm going to switch gears completely right now. So over the weekend, I get this text from Ashley, and there's been a lot of chatter online about this topic. But there is basically what I've seen online is that there's this new unfair mortgage tax on people who have super great credit, and then less of a penalty for people with lower credit. And so I wanted to just kind of get your input on what all this means. Do we have to throw everything out the window, what we've already been talking about?
Yeah, because we teach people that you should get good credit and build your credit up so you can reap the rewards of your good paybacks, correct?
Correct.
So let's talk about this, John, before we spiral any more about our credit and run up a credit card bill that we probably...
Yeah, we'll tell John what I said. So Jill basically just told everybody what's going on, and I text Jill and I said, well, I'm just going to go take my Discover and go buy 87 Louis Vuittons and crash my credit so I can get a good interest rate on a house, because that seems to be what the narrative is going towards.
Yes, you kind of forewarned me about this subject, and ironically, I was thinking about it last night and thought, well, this is a great timing for this subject to come up for this podcast. And then all of a sudden, my phone started blowing up last night and this morning about, I told you as we were getting started, I had a customer call me this morning saying, hey, if this is true, I want to stop everything. I'm not going to pay the federal government this extra penalty tax. I'm just not going to do it. And I eased his concern. I said, well, your particular loan product is not going to be affected by this. So where this is, and this is where my concern is, that we're starting to create a situation that we created in 2004 to 2007, where the federal government is stepping in where they don't need to step in. There are plenty of loan programs out there to get qualified borrowers financed. We don't need help. But the federal government always has this idea that every person deserves the American dream of home ownership. And that's what happened in 2004. They said that every homeowner or every American deserved home ownership. So we started creating all these programs for people to get into it. So now, and the other thing that really concerns me is this was done by executive order, and which means the president just signed it. And
it means it's in place.
It is. If it's not in place yet today, it's going to be in place this week.
This didn't go for a vote, is what you're telling me.
This didn't go for a vote. This is something that the president is doing by executive order. So the first thing I want to tell people is keep your good credit scores. You're still going to get a lower interest rate than somebody that has a bad credit score. But what they've done is they've said to Fannie Mae and Freddie Mac that you have to help people that have lower, you can't penalize people with lower credit scores as much as you've penalized them in the past. They can't share the burden of their poor credit. We have to require people with good credit to help share that burden. So it's this whole, trying to say things
without getting politically
getting political, but just from an economic standpoint, it's okay. I was thinking about last night and how to put it in context. If you are a member of Sam's Club, the best way that I can put it is it'd be like the federal government stepping in and saying, okay, Sam's Club, because you sell that giant size Jif peanut butter or you sell products in large capacity, you can't discount it to your members any more than what your Walmart store discounts it. So you can still buy it in large quantity, but it has to, that per unit price has to be the same as the per unit price that you're selling it at Walmart. You can no longer give people package discounts. So that's what they're basically saying to Freddie Mac and Fannie Mae, as plainly as I can put it, is they're saying, you can't incentivize people with good credit scores as well as you've incentivized them. You've got to make them pay a little higher interest rate so that you can give a better interest rate to those people with lower credit scores. So we'll give an example, and I'll use my hand. Somebody that had a 640 credit score may have, that's got a 640 credit score here, they may have an interest rate that's here. Somebody with a 740 credit score over here on the score line may have an interest rate here. Now what they're saying is they're putting this fee structure in so that Freddie Mac's going to now have to say, okay, you with the 640 credit score, you're going to get a little bit better interest rate. And you with a 740 credit score, in order to compensate for that, you're going to have to pay a little higher interest rate. So you're still going to see the higher credit score with a lower rate. There's just not going to be as much. There was
of a gap.
Right. There was this much gap before because they were paying for their poor credit. Mm-hmm. Now the government's saying, well, we've got to help them pay for their poor credit, and there's less of a gap. And so it's already what we call baked into the pricing. We've already started seeing rates go up as a result of this. For people that are saying, hey, I better hurry up and do it, well, you've already waited too long because Fannie Mae and Freddie Mac have already started the pricing situation.
I think I read somewhere back in January that it was already in play.
Yeah, they were already starting to move towards that based on, because they said that it was going to go into effect on May 1st. So it officially goes into effect May 1st, but it's already been. So yes, if you have sorry that we have to be the bearer of bad news. If you have a great credit score, you're still going to get a better interest rate than somebody with a poor credit score, but you're not going to get as good a rate. And we're now having to share that burden.
So what, if somebody's looking to buy a home right now, what advice would you give them today?
Well, it's still a good time to buy a home. You just have to be a little bit smarter, I think, because the inventory is low. So you have to make sure that you're not buying a house and paying an inflated price because the seller realizes they have a good commodity here. We've got, if I've got a commodity and there's only 4 other people that have that same commodity and there's 10 buyers out there, then I know I can offer it at an inflated price and I may get it. So right now you have sellers who are listing homes at a high price and saying, I'm not urgent to sell, it's not critical for me to sell, so I'm going to list it at a high price. And we have people that are, wanting to buy a home, and they'll have 4 or 5 people shown a home, and then they get 4 or 5 offers, and sellers are looking at, okay, which one's the best offer? So that's the first thing is don't get desperate to buy. When you get desperate to buy, you pay an inflated price. So don't get desperate to buy. Interest rates are still good, and you can always refinance. So, but we have a lower rate on this 3-year ARM to allow rates to move down and not do that 6.5–7% fixed rate. So we have a good alternative for borrowers. But still, if you're looking at an FHA loan or a VA loan or a USDA loan, those rates are in the 6s and in the low 6s, and so there's still a good opportunity, and you can always refinance as people have done when rates drop. So I'd still advise people that it's a good time to buy, because the one thing that all the podcasts that I watch and pundits I listen to, prices aren't going to make a dramatic drop. So that $200,000 home 5 years from now is going to be $250,000. It's not going to be $150,000. So you may have it at a lower interest rate, but you're going to pay a much higher premium for it. So they still encourage people, just buy smart and do your, work with your real estate agent and make sure that you're buying it at the right price.
And work with a good mortgage lender, because you've told us so much information today that's so important, and they're very, very important situational questions that you have to ask somebody, because while you do say it is a good time to buy, it may not be a good time to buy for everybody, depending on where you are in your life. And those are things you have to share with your lender. And so
you are absolutely correct. I talk with lots of buyers who many times are young buyers like yourself. That first question I ask them is, I say, where do you think you're going to be in 5 years?
A millionaire.
Well, then don't buy.
Don't worry about it.
Then don't buy this. No, don't buy a house right now, because you don't want to be tied down with a house to sell in 5 years when you can buy $1 million home.
That's
because
right.
You're a millionaire. But sometimes people in that age category are saying, well, I don't plan on being in Southern Illinois. My daughter's a good example. She's 32 years old. She's a prime candidate to buy a home. But she has a very good job with the state of Illinois. She'll be completely invested in their retirement within 2 more years. She's not sure that this is where she wants to stay. And so if you're not going to stay more than 5 years, don't tie yourself down with that asset and that liability. Go ahead and rent, because you're never going to recoup that money in 5 or 6 years. So rent for this period of time. So I tell people, I go back to that 10-year rule. I tell people, you don't know what you're going to do in 10 years, but what's your idea of where you're going to be and what you're going to do in 10 years' time? That's really the picture that you need to look at to determine whether it's worthwhile to buy a home.
Well, that's great, John. I'm so glad that you're here today with us.
I feel much smarter.
I do too. I know a lot more what's going on with interest rates, that's for sure. So
well, hopefully the people out there will be smarter and learn some tidbits, and they can always contact me and have me have a private conversation about, okay, you touched on this, you touched on that. Okay. Here's my situation. But yes, I agree. They really need to talk with a banker and describe what their situation is. And I would encourage people to get pre-approved in advance. They may say, well, I'm not in the market for another year or two. Well, get pre-approved now. We do. We have a unique ability to do a soft pull on their credit, so it's not going to be a hard hit on their credit and draw their credit score down. And do some counseling with them. Say, okay, if this is the price range you want to buy, here's the money you need to save. Here's what you need to fix on your credit to get a better credit score.
So you kind of coach them.
Yeah.
Yeah.
We'll absolutely coach them through this process.
Love it.
Well, thanks again, John. You did mention, how can listeners get in touch with you after this?
You can. My direct line at the office is 618-715-1201. You can also email me at jstreuter@myfsb.com. And you can go to just our website, the myfsb.com website, and that gives you the ability to connect with us. You can actually do an online email through our website to ask questions.
Perfect. And you're located at the Marion West branch. So if somebody is over that way, they can stop in and see you with an appointment.
Yep.
Well, great. Thanks again.
And we should be excited. Let's not forget that we're going to have an office opening in Heron pretty soon.
That's
right,
right.
very soon.
A couple weeks away. Well,
So
maybe
that's
by
it.
the time this airs, it'll be open.
Yeah.
Quinn and Kelly will be upset if we don't mention that we've got a new office opening in Heron. And we'll have mortgage services there. I think for right now, Polly Benedict in our East Branch and myself in the West Branch will share some time in that Heron office so that we do have a mortgage person there. And then Kelly Green is ramping herself up to be able to do mortgages as well. So
Amazing.
we invite the Heron market to come do business with us.
That's right. Thanks for being with us today, John.
Thank you. I enjoyed it.
Yeah, this has been great. Thanks.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.